Welcome to Investors Insights. Our topic today, jobs earned, jobs saved. Interesting topic. So often we talk about markets, stock market, bond market, what's going on in the national economy as well as globally. But today we're really focusing on jobs, and I think you'll find it fascinating. My colleagues here, Trey Booth and Ty Miller, have done a great job in explaining how jobs have a huge impact on the economic indicators that we follow so closely. So with that, Trey, the Fed surprised everybody with a 50 basis cut. And there was anticipation as to what interest rates would do. This morning in our meeting, as we were having debate and discussion, you brought some great facts to the forefront. Talk about the rippling effect of that.
Yeah, thanks, Greg. So we've been talking for a few months now that the Fed has shifted from its dual mandate focus on inflation to focusing on jobs. And there is some fear that when the Fed cut by 50 basis points, which is a large cut, and we talked about history of how rare that is, that the Federal Reserve knew something that we didn't know, that the economy may be weaker than expected, that jobs numbers may be worse than expected. And for a few months there, the jobs data did deteriorate. And Ty talked about it last week, that this month's jobs data that came out on Friday was so important because it would indicate, are we at the beginning of a trend where jobs numbers are heading up, or was the spike in the unemployment rate an anomaly, and we're still on the trend that we came out of COVID with, where unemployment rate's falling? Well, we got a good number on Friday, and the jobs unemployment rate dipped to 4.1%. So that broke the back of that uptrend in unemployment rate. So that's positive. That tells us that maybe the Fed didn't know something we didn't know. 50 basis points may have been a bit extreme, and you can see on this chart the bond market is reacting to that news with interest rates moving higher. A lot of people, when the Fed cut rates by 50 basis points, they thought that the Fed knew something we didn't know, and that the economy was in a recession, which means interest rates are going to go nowhere but down from here. Well, that's not what's happening. Since the Fed cut rates, you can see the 1-year, 5-year, and 10-year Treasury here on this chart. All those rates are actually higher. The 10-year Treasury is now sitting at 4% this morning. And it had dropped as low as below 3.6% after a Fed rate cut. So the bond market initially was looking like we were going into recession with interest rates falling in a recessionary environment. At the same time, the stock market was actually rallying. And as Ty pointed out, the stock market is anticipating 15% earnings growth next year. Earnings do not grow while the Fed's cutting rates, because the Fed's usually cutting rates to stop a falling economy. For now, 1 month in, it looks like the stock market's winning, and the bond market with rates coming up is catching up to the stock market that maybe we're not heading into recession. So that's positive news. Don't want to be too Pollyannish, though. There was some negative news under the hood. You can see on this chart, it shows where the jobs came from. The 254,000 jobs that were created last month, 78,000, the largest portion was leisure and hospitality. As we've talked to before, to transition this economy, we've been in a very heavy leisure and hospitality-driven economy post-COVID. A lot of people going on trips, going to see concerts. To get to the next leg, we need to transition from that kind of consumption-driven economy to more of a manufacturing and construction-driven economy that we need lower interest rates for. And sadly, manufacturing actually lost jobs last month. So we're not really getting the sustainability trend that we want to see. But all in all, positive. But there's some cracks beneath the surface we're going to be looking at to see if this is actually sustainable. Who's going to win out? Is it going to be the bond market or the stock market?
Yeah, I love your details. I love the way you explained it. I think our viewers will be able to take this information and share it with others. And also on our social media, we'll continue to have this dialogue about jobs on the Facebook, Twitter, LinkedIn, YouTube, our podcast. That's a big topic for us. And I also appreciate that you mentioned that Ty talked about it last week in the vlog, and encourage people to go back and just track us on this. But jobs have been a big topic, and in relation to interest rates. So great job, Trey. Thank you for that insight. And then Ty, you turned right around and talked about jobs saved. Trey's talking about jobs earned. Seeing unemployment come down. Talk about jobs saved. The longshoreman scenario there could have been a train wreck for us. So talk about that.
Yeah, so I'm talking about the port strike deal that was reached last week. The International Longshoremen Association Union and USMX, you reached on a tentative deal. They're still working out a few things, but essentially they have a basically 100-day window until January 15th to finalize everything. But as of now, the strike is over. The main kind of concern at this point is automation. We currently use a lot of manual labor, a lot of workers out there, not as much automation on our ports. And so that's kind of the one thing that's still driving this agreement. But it appears that they have, at least agreed on wage increases for the workers. Kind of looking back, Strategas put out some data regarding, what the port strike was going to look like had this deal not gone through. And so, here's, as you can see in this chart, some key points. The strike would shut down 14 port authorities on the East and Gulf Coast. USMX was offering a 40% wage increase over 6 years. The longshoremen wanted an 80% wage increase over the life of the contract over that 6 years. So they were able to meet in the middle there a little bit, more on the higher end towards that 80% number, not quite there, but higher than 40. And then, kind of worries of a strike, resulted in recent import increases. We're still trying to work through inflation, even though the Fed is now focused more on jobs. Inflation can always creep back up, especially with situations like this. One stat that I found interesting was every day that the strike would have lasted would have taken 5 or 6 days to get ports to operate normally again. So, I mean, you're talking about, if the strike lasts, upwards of 30 days or something like that. That's a pretty significant increase on, a delay of ports operating normally again. So, some key facts there. But the good news is that for right now, it appears that all is solved and they will work through this automation issue over the next 100 days.
That's great. Yeah, people don't realize what we dodged there in that whole scenario. So a lot of good positive news taking place here. We're going to keep you updated as the week progresses. I can't believe that we're already in October, the fourth quarter of 2024. Just know that a lot's going on, and we still have things to bring you up to date on. And know this, that we're always not only looking as to what the headlines are in the news that day. Yes, we watch that closely, but we like to bring you the details and the information that really tie in to what's going on behind the scenes, what causes the rippling effect, so that you have information that gives you confidence if this market starts to bounce around. Every day we're striving here at Five Plan Partners to see to it that our clients have a better, richer, fuller life. And we thank you for watching this vlog and believing in us. Have a great week.